Welcome to another episode of Income Fund Fundas, Simplifying Debt Markets, hosted by yours truly Sunil Javeri and brought to you by Axis Mutual Fund. Today's query by a viewer after viewing my earlier episode is, in one of your episodes you spoke about asset allocation. What is this and why is it important? I had mentioned in that episode that 92% of your returns are from asset allocation and only 8% is from stock selection or market timing. Now, what is asset allocation? When markets become expensive in terms of valuation, it can be price to earning, price to book, and so on and so forth. As far as equity markets are concerned, that's the time one needs to move away from equity, reduce the exposure there, and bring the money into debt as an asset class. And at the same time, when the markets become cheap, the valuations become cheap as far as equities are concerned, you have to move back from debt as an asset class back into equity as an asset class. Similarly, when the interest rates go up, that's when the investors can invest in debt as an asset class and hope to generate better returns on an ongoing basis going forward thereafter. And when the interest rates go down thereafter, it generates better returns as far as investors are concerned, because once the interest rates go down, as I have explained in the earlier episode, the price of the bonds tend to go up. There is a reverse correlation which we have discussed in the earlier episodes also. So the money should move from an expensive asset class to a conservative asset class, and conservative asset class to an expensive asset class, and that's what we call asset allocation based on the valuation matrix. It can be a valuation matrix of debt or it can be valuation matrix of equity as an asset class. Equities do well in expansionary economy when the markets, the growth of the country is happening. The GDP, what we call gross domestic product, also starts increasing. When manufacturing activity and everything picks up, that's when equity is supposed to do well. And in a contractionary economy, the debt markets tend to do well, and that reverse correlation gets captured very beautifully in asset allocation. That asset allocation gives stability to the investors' portfolios instead of making it extremely volatile from either asset class. And it gives you a much smoother investment journey, and that is what the investors should be expecting from their investments, rather than too much of volatility and too much of up and down in their portfolios. I hope viewers have understood the importance of asset allocation and what is asset allocation. Thank you so much. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.